This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
We got our last couple in the quad rented, and we got the last one of a duplex rented. And so we have full occupancy, and it sure feels good to get the full check every single month. It's just a great feeling. And so hopefully in December, we're going to take over 2 more. And actually before then, take over some from Alabama, actually all, and then Memphis as well.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome, empowered investors. This is episode 2282, and I am coming to you from beautiful Medellin, Colombia, or as the locals say, Medellin. I just can't quite get myself to pronounce it that way, but that is the correct way. Anyway, got a couple of data points here I want to share with you before we get into today's topic, which is fundamental stuff, 10 commandments of successful investing. This is just core content that so many of you say you want to hear. So that is coming up for you in just a moment. But first, some foreclosure data. Foreclosures. How bad is the foreclosure market? How realistic is the stuff you hear from the doomers? Now, certainly the real estate market, I have reported many times, has been pretty darn boring for the last year. And I think we're going to see that continue for just a little bit longer, but I think it's about to unfreeze. And I heard a very, very interesting theory. Wow, kind of blew my mind this morning from Anthony Pompliano, and it was about the Trump administration trying to intentionally slow the economy. Yes, I know that sounds absolutely nuts, right? Why would any president want to do that? Well, I take that back. There are some that did want to do that for sure. But I don't think this president would want to do that. However, there has been a lot of pressure and a lot of talk about forcing the Fed chair out, forcing the Fed to lower interest rates, which would obviously speed up the economy. We all know that. And you probably saw, and we reported on the news about how Jerome Powell was being extremely defiant about that. And, I don't blame him, right? The Fed is supposed to be separate from the government, but whatever, right? And Richard Duncan, when I interviewed him in Bangkok live in person, you heard that just recently, he talked about the end run around the Fed, which the Trump administration could do. But here's another way. Here's another way they might be trying to do it, and that is to just generally slow the economy. We are going to have some bumps in the road, folks. Get ready for it. It's definitely coming. Trade wars, tariffs, chaos. It's a lot of stuff going on. But through it all, the most historically proven investment will be income property. And we just don't see any sign of any big doom and gloom, as you hear from some of the doomers, like Peter Schiff, who's been wrong since 1982. I didn't actually say that, but you heard me repeat it before. I was on this live stream with Peter, and he was talking away, and he sounds so brilliant, and he is a really smart guy. There's no question about it. But someone wrote in the chat, Peter Schiff has been wrong since 1982. And that's pretty much how it is with the doomers. They just underestimate the power of human ingenuity and the power of 8 billion people waking up every single morning thinking one dominant thought, which is, how can I improve my situation? And as they do that, they're going to create value in the economy, value for others. And it's just a beautiful system, the way that works, right? But here's some foreclosure activity. And it is still extremely low. In fact, it got even lower than extremely low. If you're watching on video, you see this chart, and back to the Great Recession, foreclosures were through the roof. There was so much foreclosure activity. It was unbelievable. And this chart that I'm showing on video looks like just a pointy chart at the top of the Great Recession. And since then, foreclosures have been pretty much just declining. During the COVID era, they declined even more to incredibly low historical lows that even if you go back much further, they were never that low. And there were the foreclosure moratoriums, right? We know about that, the eviction moratoriums, the foreclosure moratoriums, that all happened. But we didn't really need that at all, because think about it. Think about the COVID era and all of the doomers and all of the doom and gloom you kept hearing. You saw it all over YouTube. In fact, my buddy Ken McElroy made a video. He said, write this year off. And so many of you asked me about that video because you know Ken and I are business partners. And he was super negative about the whole thing, as were so many other people. And so many other people were saying, I've got cash. I'm going to pounce. This is going to cause an immense real estate crash. And it didn't. All of those people missed out because it went the opposite way. The real estate market boomed. And one of the reasons was that they underestimated the government and the central bank response to the crisis. And as they underestimated that, the market went through the roof and we saw a massive appreciation. We all know the history, right? But think about it. If you are one of those people trying to time the market, you would have just completely missed out on that. In fact, you would have missed out on a lot of good cycles. But that said, we don't even depend on cycles. What we depend on is just reliable investments that produce a good overall return on investment. And if you want to know how to calculate those, go get that free video at jasonhartman.com. It's right on the front page. And look at the performas in the properties section of jasonhartman.com. And you'll see that even with very conservative assumptions, they perform at above 20% annually, because income property, of course, is this beautiful multidimensional asset. Unlike other assets, you make money in many more ways. And so back to the foreclosure activity here and how everyone just screwed up on their predictions about what would happen and about the way they dealt with it and the way they were keeping their powder dry and waiting to time the market. And they were just wrong. They just totally missed out. Over and over again, this happens throughout history. And so this foreclosure activity went up a little bit as the moratoriums went away after COVID, right? There was a little bit of an adjustment, but it's still the lowest foreclosure activity on this entire chart that dates back over 20 years. And now foreclosure activity even went down slightly in the last month. So again, all of the doomers, they just miss out all the time. And nobody ever counts what they miss, right? Because that's not the way the human mind operates. You can't hear the dogs that don't bark. Sure, everybody talks about the one that got away once in a while, but a lot of people just don't talk about it at all because, well, they're kind of embarrassed, honestly, that they missed out and they didn't have the confidence to do things that would have yielded great returns for them. So here's another chart I'm showing, and this is the percent of loan balances that are 90 days or more delinquent by different loan types. Okay, so credit cards, auto loans, mortgage loans, and they separate out HELOCs because that's a different kind of mortgage, a home equity line of credit, and then student loans. So we've got these 5 different types of loans. And where would you think the biggest delinquencies are? Well, of course, they're in credit cards. Now, they've gone up recently, but they're certainly not the worst they've been. They were much worse during the Great Recession. And right now they stand just over 11% of people on their credit cards are 90 days or more delinquent in paying the bill. And then you look at auto loans, and you've got about 5% of people that are 90 or more days delinquent on their auto loan. Now, what isn't this telling you? Well, we have got one of the oldest auto fleets in quite a while, maybe ever now on the market, because these cars are so much better than they used to be. And no one really interprets that. They think about, oh, the cost of cars went up so much and, all of this, but they don't think about how much better the car got. In fact, if you are old enough And if you were alive in the 70s and 80s, for example, and of course before that, in the 60s, the 50s, definitely before that, but even back to the 70s and 80s, not that long ago, it was a legitimate excuse that is not a legitimate excuse now, okay, at least not in the US, right? It was a legitimate excuse back then to say I was late because I had car trouble. Just think about the last time you ever heard someone make that excuse. I was late because I had car trouble, car repair problems, right? Nobody has car trouble anymore because the cars are so good and so reliable nowadays that that's just not even an excuse. But it used to be an excuse just recently, 60s, 70s, 80s, right? That was a legit excuse to say I had car problems and that's why I couldn't make it, or that's why I was late, right? It's not a legit excuse. No one would believe you. Like, what would be your car problem nowadays? The car starts every time. It works. It gets you there. It's just never a problem. So one of the things this chart isn't telling us is that the fleet has gotten much older, the fleet of automobiles out there. Usually it takes about 12 years to replace the entire fleet. So when self-driving cars come out, that'll be such a giant innovation that everybody will rush to replace the fleet. In fact, I would predict there'd be some government pressure or regulations requiring that people replace the fleet. But that's a whole nother discussion. Cars as a service, like SaaS, software as a service, CAAS, cars as a service, that's definitely coming and coming really quickly. But a lot of people have paid off their cars. So what this doesn't tell you is that, yes, delinquencies are kind of high. They're not super high. They were just as high, about 2019. They were just as high as they are now. And they were just as high during the Great Recession. Interestingly, not higher. So they stand at about 5% of the people are 90 or more days delinquent on their auto loans. But a lot of people don't have any auto loan at all. See what it doesn't tell you? Why that's so important, right? So they have no auto loan, so they can't be delinquent on a loan they don't have because their car is old and they paid it off. All right, mortgages, extremely low delinquency. And if you're looking at the chart, you saw that 9% of people were delinquent on their mortgage during the Great Recession. Just a huge number, almost 1/10 of the entire mortgage market. And HELOCs, same thing, very few delinquencies on the HELOCs. And they also put in here student loans. Now, student loans are different. A lot of people would love to be delinquent on their student loan because after they graduated, they probably realized their student loan was largely a scam, and it was. College should be way less expensive, and it's a big giant scam. But that's another topic. We've talked about it before. So people aren't delinquent on their student loans because they can't bankrupt out of them. They're an unbankruptable, unforgivable loan. So again, there's no relief for student loans. But these mortgages, people are extremely comfortable and they have no incentive to be delinquent on their home mortgage because it's so cheap. Now, it is changing a bit, and the mortgage lock-in effect is slowly going away, very, very painfully slowly, because that would free up a little more inventory if it went away and there'd be a more dynamic market than we have now. But anyway, you've got about 25% of the people still have a mortgage at or below 3%, about 65% have a mortgage at or below 4%, and about 85% have a mortgage at or below 5%. So still super cheap mortgages, but what doesn't it tell you? About 40% of the people have no mortgage at all. So again, super low default rate there, very comfortable people, not selling, not crashing the market, far from it. We're just in kind of this, I would call the real estate market. The economy in general. And I predicted this right at the beginning of COVID. I predicted stagflation. And I do think we're definitely seeing some stagflationary vibes going on. It's not really stagflation. It's not like the stagflation of the 70s. But we are seeing, definitely, I think we could call the real estate market somewhat stagflationary because there's not much activity, but prices are still rising. And they're not rising as much as they were, but they're still overall rising. And on an episode coming up, I've got a breakdown market by market in a whole bunch of major metros. Have you ever wondered how the top real estate investors consistently find the best deals before anybody else? Well, listen up, because this can transform how you invest. I'm excited to share something that's revolutionizing the real estate game. It's called Connected Investors. This is a really cool platform that gives you access to all of the property records nationwide. Truly amazing. It's not just a platform though, it's a secret weapon. It does a whole bunch of things. Besides the property data, it's a social network as well. It's built by successful real estate investors for real estate investors. Find off-market deals instantly, access accurate ownership contact info, make smart data-driven decisions, and secure funding for your deals from a vast network of private and hard money lenders. Whether you're a beginner or a pro, Connected Investors is your go-to tool for smarter, faster, and more efficient investing. Try a 7-day free trial at jasonhartman.com/connected. Again, that's jasonhartman.com/connected. And let us know how much you love this software. So, Empowered Investor Live is coming up too. You got to get your tickets and register and join us for Empowered Investor Live. Before that, though, I will tell you, we have a masterclass coming up, and you can register for that. jasonhartman.com/Wednesday for our monthly Wednesday masterclass, and jasonhartman.com/Wednesday. And for Empowered Investor Live, if you'd like to join us for that, meet all of us in person, have a great time. We will be in Southern California early April. Registration link for that is empoweredinvestorlive.com, empoweredinvestorlive.com. And let's go to the rest of today's episode. Today, I would like to talk about inflation, but really I'd like to talk about leverage, but leverage specifically as it relates to the concept and the reality of inflation. When you use leverage or borrowed money, there are many, many benefits. The prudent, proper use of leverage, a very powerful tool, could be a destructive tool. Some people get themselves into trouble with it. But when you use it the right way, especially when investing in real estate, it is an incredibly powerful tool. The main benefits, although there are many others, and in our other podcasts you hear us talk about leverage, is to reduce risk and increase return on investment. However, this podcast is specifically geared toward inflation. In fact, I call it the Great Inflation Payoff. Now, if you ever have a chance to attend one of our seminars or meet or talk with one of our investment counselors, they will be glad to run some phenomenal inflation calculations for you. And these will show you how much benefit, yeah, that's right, I said it right, benefit you are actually getting from inflation as a real estate investor. So let me just say this to make it simple. Think about this. If you were to purchase 6 single-family homes and the aggregate value of those single-family homes was $1 million, and if you were to put 5% down on those properties, assuming you could qualify based on 5% down, your loan balances would be $950,000. Think about this. If inflation is 4%, in 1 year, if you've paid down no principal whatsoever, your loan balance reduced just because of inflation to just $912,000. Essentially, inflation paid off, if you will, $38,000 of your loan balance for you. This is what we call the Great Inflation Payoff. Borrowed money offers those two great benefits, reducing your risk and increasing your returns. But better than all of those is the benefit of inflation, because better to borrow money today and pay it back later than to pay money back today. And real estate has some especially beneficial features with inflation, because what happens, think about it, our rental properties, the loans on them, the debt on them is paid back by our tenant rather than by us, or at least as much as possible, the tenant pays off our loan balances for us. So more on this later. I'd like to just play for you part of a recent live seminar where I talk about the Great Inflation Payoff and some of these benefits of inflation. Now, also, you have to understand that since you cannot see the visual aids being presented, you may have a question or two that is apparent and obvious to the live audience. So just give any of our investment counselors a call. They'll be glad to give you visual aids or explain things in more detail to you. And I will be back at the end of this podcast to tell you more about the inflation payoff and just sort of wrap this up. Thanks for listening, and let's tune into a recent live seminar. Now, let's talk again about inflation. If you go onto Google and type in inflation calculator, you can find these all over the internet. These are just 2 screenshots of inflation calculators that I found typing that into Google. So, remember, I asked you earlier today, would you rather have $100,000 today or $100,000 in 10 years? And everybody said today they'd rather have the money. And then I asked you, would you rather pay $100,000 today or pay it in 10 years? You all said, I'll pay later, take it today. Right answer, definitely. If you have a $100,000 mortgage on your property, and say it's an interest-only loan, we're not paying the principal down, it's just interest only, and it's a 10-year loan. If you believe, which you'd be crazy to believe it, but if you believe that inflation is only around 4% a year, as the government would have you believe, then after 10 years, if your loan is interest only, your statement still says $100,000 on it. But remember, you're paying in depreciated future dollars. So you're really only paying back $66,000 10 years from now. Better to pay later than to pay today. What if inflation is 8%? Personally, I think it's 10 to 12%. That's my opinion. $100,000, 8% inflation, 10 years go by, you're really only paying $43,000 in 2017 dollars. So debt works for you really well when you're the borrower. When you're the lender, debt really hurts you. When you buy bonds, you are the lender. When you buy bonds in a company or government bonds. That's why bonds are lousy, because I don't like being the lender. You know, Shakespeare a long time ago said, neither a borrower nor a lender be. Shakespeare was wrong. Be a borrower. Don't be a lender. Lender, no, lousy. I ask you a question about borrowing and lending. How many of you have ever loaned money to a friend or family member? Who was in control of that transaction, the lender or the borrower? Like I said, be the borrower. That's where you have control. So let's look at this example. Here's the bank. You go to the bank and you say, bank, I'm a real estate investor. I want to borrow money to buy this house. My name's Donald Trump. I got a comb over and I'm going to buy this house. And I want you to loan me the money to buy this asset. But look, bank, I'm going to own the asset. You're just financing it for me. You're not going to get any of the tax benefits. You're not going to get any of the appreciation. All you're going to get is interest on the loan. And then I think, well, this sounds like a pretty good deal for me, the real estate investor. But the only problem is I got to pay the mortgage back. I've got to pay the loan back to the bank. What if I could avoid paying the loan back? Wouldn't that be neat? So what do? I rent the house out to Heather Locklear, one of my personal favorites. So Heather becomes my tenant, and I'm going to say, look, Heather, effectively, you're going to pay the bank back for me. But it gets better than this. I borrow money from the bank, say at 7.5% blended rate. What that means in the blended rate is if I get 2 loans to put minimum down payment, say I do 80% on my first loan, 15% on my second loan, 5% of my own cash down. The blended rate is the blending of the 2 loans. The 80% loan is a larger balance at maybe 6.75%, for example. And the second loan is a more risky loan for the bank to make. So they're going to charge me a higher interest rate because they're in second position when it comes to collecting. So they might say, well, I want it 12%, but it's only a small amount of money. It's only 15% of the purchase price. So the blending of the 2 might come out to 7.5%. So that's the effective blended rate. All right? So I pay the bank, or really Heather Locklear pays the bank, in depreciated future dollars. Okay? And the asset historically appreciates faster than the rate of inflation. Now, most people see how they win the game in real estate this way, but they don't see how they win the game in real estate this way. You don't win one way, you win 2 ways, by borrowing money. And the problem is, the bank isn't stupid. They understand inflation. I mean, how many MBAs are working at any bank? Lots of them, right? They went to school, business school, they learned about inflation. So they know this is out there, but they think inflation is only 4%, like the government tells us all, right? But they also realize that, look, if we want our money not to depreciate, we've got to charge an interest rate higher than the rate of inflation to offset that. So we might loan the money out at 7.5%, believing inflation is 4%. So our margin effectively is 3.5%. That's our profit to the bank, if you will. It's more complicated than that, but simplified example. So the bank knows this. So they're going to charge me a rate higher than inflation. So see, if I bought vacant land or if I didn't rent my house out, I would actually suffer because I'm not getting the tenant to pay my mortgage back for me. But we call this tenant-backed or tenant-financed debt. That's when debt is good, when someone else pays it off for you. Okay, you get the benefit of inflation. Destructive debt, which is consumer debt. This is how people get into trouble with debt. They get into debt over the appearances of wealth. Clothes, cars, vacations, plasma TVs, stuff that depreciates in value that you can't rent out. I remember about a year and a half ago, I got a call from a gold dealer, Monix. It's a local company here in Newport Beach. You may have heard of them. And he calls me up and says, Mr. Hartman, we think you should invest in gold because all the fundamentals are right, blah, blah, blah. It's $420 an ounce now, and we think it's going to go to $1,000 by the end of the year. Well, it didn't, but it did go up. I bought it. So I said to the guy, I said, look, I will send you $5,000. You send me the 12 gold coins. And so you've made the sale, but I have 2 questions for you. I'm going to buy it, but I want to know 2 more things. Number 1 thing I want to know is, will you finance my purchase for 3 decades, for 30 years, at some of the lowest interest rates in 40 years, tax-deductible interest? And he says, we don't do that. And then I said, okay, fine, I'll pay cash. Then I want to know, can I rent my gold coins out to someone? And he says, I don't think anybody rents gold coins. See, that's why that doesn't work as an investment. Anything you can't buy, get someone else to finance for you, take huge tax deductions in between, and you have a renter generating income, is not a good investment. That's why I don't buy vacant land, because I can't rent it out. Unless it's a parking lot, I guess. That might work. But that's the reason this works so well. Don't get into debt over the butter of life. Get into debt with guns, the guns and butter philosophy. Guns are things that create wealth. Butter is the luxuries of life, the things that really diminish wealth over time. The entire tax code and the U.S. banking system encourage this. Do what they want. Play their game. Diversify your equity for greater safety. Move it out of the high-price market into the better value markets where the properties make sense the day you buy them. Constructive debt is investment grade debt, okay? J. Paul Getty said it well. He said, if you owe the bank $100, that's your problem. If you owe the bank $100 million, that's the bank's problem. So the borrower is in the position of power. Just remember that. A couple things I want to mention to you is that during the break, Cliff came up to me and he talked about the RV ratio and why we move out of markets. Actually, when we move out of a market, a lot of times it's good news for the people that already bought there. And the reason is that the way markets play out, at least what I've noticed over the years, is that prices will start to appreciate. And then behind that, you have the lagging indicator of rental income, of rents. And think about what's happening in Orange County right now. The RV ratio is typically about a 0.3. So here, $1 million house rents for about $3,000 a month. And I know that because Marcus sold his house, Marcus Milliton, who was just up, and rented one. And he rents a house that's worth about $1 million for $3,000, I think $3,100 a month. And it was really a good idea to sell his house. Now, he has 4 kids, and his wife, Marjorie, just about had a fit when he said, we're selling the house in Ladera Ranch and we're going to go rent. Huh? No, we're not. I'll call my attorney. But really, it is a much better deal to rent a house here right now than to own one at the moment. So what happens is you'll see the prices appreciate. That's the leading indicator. Then you'll see the rents follow. That's the lagging indicator. So they get so out of sync. And what may confuse you is that you might read in the media right now that rents are going up. in the bubble markets. They're going up more than they are in the non-bubble markets, and that is true. But they're so out of sync here, it's ridiculous. Think about what has to happen here. The $1 million house needs to rent not for $3,000 a month, but for $7,000 a month for this market to work again. And I believe that the RV ratio is a predictor of appreciation. And here's how. When you get to about the 0.5 RV ratio, that's what I think is sort of the equilibrium rate. What'll happen in Orange County, in my prediction, is you'll have the $1 million house, it'll decline in value to about $800,000. And this is really all of California, largely. So that'll decline in value as rents creep up, and they'll sort of meet at the point of equilibrium, which will be the $800,000 house renting for $4,000 a month, 0.5. It was $1 million. It went down to 800. The rents went up from 3,000 to 4,000, and you're at the equilibrium point, and that's the sign that the market is starting to get healthy again. And then the last thing is, I want you to consider the assets you have in your life. Most people look at a balance sheet. You all, of course, know what a balance sheet is. On one side, it's got your assets. The other side, it's got your liabilities. But one of the assets that people generally don't count, and they don't even think about that they have, is their credit. Their ability to borrow. And in this game, as we've demonstrated to you today, the ability to borrow and leverage an investment is an incredibly good asset. So remember, when you're thinking of a balance sheet, count your liabilities, all the debt you have, but also count as part of your assets your ability to borrow. And remember, the concept of your financial life is you always want to make all your assets work as hard as you possibly can. So if you're not using your credit to borrow and put it to work for you, then it's an unused asset, earning nothing for you. I constantly have people that kind of brag about, well, I have an 800 FICO score. Well, you have no debt. Of course you have an 800 FICO score, but you're also going to end up poor, and other people are going to end up rich because you're not using that asset, your credit asset. When you buy these properties, your credit score will go down initially. It goes down, and then in about 6 months, it sort of starts to recover. So as long as you maintain a credit score above 720, you're in very good shape. But remember, their credit doesn't do anything for them unless they use it. So use your credit. It is an asset. So keep that in mind. Don't just let it sit there not working for you, all right? So what's the plan with this? Well, the plan is divide your debt strategy into stages. Stage 1 is the launch stage. When something is on sale, I don't know about you, but when something is on sale, I stock up. Money is on sale. Debt is on sale. It's on sale in not one way, low interest rates, but two ways. Ease of qualifying, and that's gotten harder and the rates have gone up just a tad. But when I got into the business in 1985, interest rates were 14%. So when something's on sale, stock up. Money or debt is on sale. Look at folks, in 5 years, 10 years, I'll bet you people are going to say, God, I wish I had borrowed more money when it was so cheap. I wish I had taken out more mortgages when I could have done them with 5 or even 10% down. Now it's 20% down and the rate is 10% or 14% or whatever it is. I don't know what the rates will be, but I know that now it's a mighty good deal. So in stage 1 of your wealth building plan, you stock up on high quality, fixed rate only, investment grade debt. The debt is like the booster rockets in the space shuttle. Without the booster rockets, you could never get into orbit. So stage 2 is you jettison the booster rockets. You can let them go if you want. I still don't recommend it. But really what we say here is don't jettison the debt. Use the refi till you die plan. And what you're doing here in the stage 2 is you're starting to enjoy increased rents, appreciation, and tax savings over the years. And remember, this is 5 years we're talking about, 7 years we're talking about. And then in stage 3, that's the orbit stage where you continue to refi till you die over and over again and enjoy living on the tax-free proceeds of the refinance. So I hope you enjoyed that piece from a recent live event, and we hope you'll be able to attend one in person sometime for more and more details. But just remember that inflation calculator example that I used in the beginning. If you were to purchase $1 million worth of properties, say, for example, in our network, that might be 6 single-family homes in diversified markets spread around the country so that all your eggs are not in one basket. You're spread out, you're diversified for greater safety. Now, You borrow $950,000, 5% down, just like the example I talked about earlier. And the inflation rate for the next 10 years on this interest-only loan, the rate of inflation is only 4% per year. It's really quite a bit higher than that, but that is a much longer other discussion for a future podcast. At the end of the 10 years, remember, you had an interest-only loan, so it's now 2017, 10 years in the future. Your statements still show a loan balance of $950,000. $950,000. But because of the beneficial effects of inflation, your loan balance is really only about $912,000. Your total return on inflation is about 250%. That's another way to say ROI. Remember, the traditional understanding of ROI is return on investment, and that's true, and that's a good thing to look at. And if you check out our previous podcast, ROI, some people just don't get it. We explain in depth how to calculate return on investment. But a new definition for ROI, since we're moving on to more advanced techniques here, is return on inflation. That's right, return on inflation from the benefits of inflation. And any of our investment counselors here at our Orange County office would be glad to run a projection, a scenario, and fax or email or mail it to you or sit down with you in person of how much benefit you're getting from inflation. But remember, the inflation benefit is twofold. Number one, when you buy real estate, you're investing in an inflation indexed asset, an asset that is traditionally a great hedge against inflation. That's one benefit. That's the obvious one. Most investors understand that. But the other benefit is that you are paying back the debt on the real estate in depreciated future dollars. Would rather have $1 million today than $1 million in 10 years. So the benefits of inflation are twofold, not just one thing, two very big benefits of it.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.